Um, so in late February of 2026, the Strait of Hormuz was just abruptly blockaded. And over a matter of days, 20% of the world's seaborne oil simply vanished from the global supply chain.
Yeah, completely vanished. And not just oil, but 20% of the world's liquefied natural gas was entirely choked off too.
Right, so the global energy markets entered this state of sheer, unadulterated panic. I mean, Brent crude oil blasted past $126 a barrel. Nations were realizing they might literally run out of fuel.
Exactly. And so logically, you would assume that the price of, the ultimate safe haven energy fuel, which is uranium,
Yes,
would absolutely skyrocket, right?
you would think so. But instead, the spot price of uranium plummeted by nearly 16% in a single week.
It is honestly one of the most fascinating economic paradoxes we've seen in modern market history. I mean, you have a scenario that echoes the worst feels of the 1970s energy crisis.
Yeah.
A situation where the physical reality of energy scarcity is undeniable, and yet a critical energy asset just violently sells off.
Well, welcome to a special macroeconomic deep dive. We are speaking directly to you today, whether you are managing a portfolio, trying to prepare for a corporate strategy meeting, or you're just someone who wants to understand how the mechanical gears of the global economy actually behave when a massive wrench gets thrown into the machine.
And this was a massive wrench.
It really was. So our mission today is to untangle the absolute chaos that defined the first quarter of 2026. And we're relying on a pretty extensive stack of data for this.
Yeah, we've got a lot to get through.
We do. We're pulling from the day-by-day historical tracking of the 2026 Strait of Hormuz crisis and the broader Iran war. Plus, we're diving deep into the Q1 2026 Strategic Analysis Report.
Right, and we're also looking at corporate updates directly from industry titans like Kazatomprom and Cameco, and parsing through the granular market reporting from the ANS Nuclear Newswire and the Investing News Network.
Yeah, the volume of data generated in Q1 was just staggering. But what makes this specific collection of sources so valuable is the contrast, I think.
Oh, absolutely. You have the military and geopolitical tracking on one side, and then highly specific, heavily regulated commodity market data on the other. Watching those two spheres collide is, well, it's what creates the anomalies we need to dissect.
Now, I want to be incredibly upfront with you about why we are doing this deep dive right now in mid-June of 2026.
Right, the timing is important.
It's crucial because when this crisis initially erupted in late February, the global financial markets lost their collective minds. Releasing an analysis in March would have been an exercise in futility.
Yeah, it would have just been adding our voices to this deafening echo chamber of speculation, fear, and, just noise.
Exactly. By enforcing a strategic delay and waiting until June, we've secured the ultimate analytical advantage, which is hindsight. The geopolitical dust has had several months to settle.
The algorithmic panic selling has totally exhausted itself.
Right. So we're now in a position to look at the hard physical data with absolute clarity to see what actually happened to global macroeconomics, and we're zooming in specifically on the bizarre behavior of the uranium market.
Because hindsight removes emotion from the equation. In February, paper traders were just reacting to the velocity of news headlines. Today, in June, we can look at what physical commodities actually did.
Where the ships actually sailed.
Exactly. And what contracts were actually signed. The lag time allows the truth of the physical market to emerge from beneath all that financial volatility.
But real quick, before we really get going, there is a crucial disclaimer we've got to establish for you.
Yeah, this is very important.
Right. So our source materials cover some really intense, real-world events that are inherently politically charged. We're talking about the U.S.-Israeli military strikes on Iran, the assassination of Iranian leadership, and the resulting war.
And the maritime blockades, obviously.
Yeah. So we need to be unequivocally clear with you, the listener. We are not taking sides here. We are not here to endorse or condemn or even evaluate the political, diplomatic, or military actions of any nation involved in this conflict.
Not at all. Our function in this deep dive is strictly as impartial analysts. We're looking at the factual geopolitical events purely as inputs, and we're measuring the economic data purely as outputs, just so we can understand the monumental impacts on the global supply chain.
Right. Because the global market is, it's an entirely amoral mechanism. It doesn't care about the geopolitical justifications of a blockade.
No, it really doesn't. It only calculates the missing barrels of oil and the delayed shipments of natural gas. That is the exact lens we're applying today, tracking the supply chains and the capital flows. Nothing else.
Okay, so that brings us back to the central hook of our deep dive, the paradox of Q1 2026. The world was gripped by a terrifying energy crisis, yet the spot market for uranium acted like some hypervolatile tech stock.
Completely decoupling from the rock-steady, decade-high upward climb of long-term nuclear fuel contracts.
Yeah. And to understand how that happened, we have to start with the macro shock. We have to understand the geopolitical earthquake that shook the global energy landscape starting on February 28, 2026.
Because you really can't understand the ripples without first measuring the boulder that was dropped into the pond. And the escalation on February 28th was just a seismic event for the global economy.
Let's lay out the timeline from the sources. On February 28th, the United States and Israel launched Operation Epic Fury, which was a massive jolt air campaign targeting Iranian infrastructure.
And this operation included the assassination of Iran's supreme leader, Ali Khamenei.
Right. And the immediate Iranian retaliation involved missile and drone strikes across the region. But their most devastating countermeasure wasn't necessarily kinetic. It was geographic and economic. They moved to close the Strait of Hormuz.
Yeah. And the Strait of Hormuz is arguably the single most vulnerable artery in the entire global economic system. Geographically, it's a narrow waterway connecting the Persian Gulf to the open ocean.
At its narrowest point, it's only about 21 miles wide.
Right. But the actual shipping lanes that deep-water supertankers can safely navigate are only 2 miles wide in either direction.
Why? Only 2 miles.
Yeah. So when Iran's Revolutionary Guard Corps began laying sea mines, firing projectiles, and actively boarding merchant vessels, they effectively clamped that artery shut.
And the scale of what flows through that 2-mile-wide lane
Yeah.
is just hard to wrap your head around. The data indicates that before the blockade, 20% of the world's total seaborne oil trade moved through that choke point.
It's staggering.
And even more critically for the modern energy grid, 20% of the world's liquefied natural gas, or LNG, passed through that same narrow channel. What actually happens mechanically to the global supply chain when you sever that connection overnight?
Immediate systemic paralysis. I mean, the physical reality of the oil market relies on constant, uninterrupted motion. Tankers are essentially floating pipelines.
Right.
So when the strait closed, up to 10 million barrels per day of oil from Kuwait, Iraq, Saudi Arabia, and the United Arab Emirates suddenly had nowhere to go.
It just sat there.
Yeah, it just sat in storage facilities that rapidly approached maximum capacity or unloaded tankers idling dangerously in the Gulf.
Unbelievable.
And the commodity markets realized instantly that a massive fraction of global energy was stranded. The reaction was violent. Within days, Brent crude oil, the benchmark for global prices, blew past the $100 threshold.
And by March 8th, our sources show it peaked at $126 a barrel.
Exactly.
That price spike isn't just a number on a screen either. It acts as this massive regressive tax on every single physical good that moves across the planet.
Oh, absolutely. But, the oil shock almost feels secondary when you look at the natural gas implications.
Yeah, let's talk about that. The sources point out that Qatar Energy, which is just an absolute behemoth in global LNG supply, had to declare force majeure on their exports.
Right. Their massive transport ships literally could not secure insurance to navigate the strait, let alone guarantee the physical safety of their crews.
And the LNG aspect is what turned this from a regional oil shock into an existential crisis for Europe. The timing could not have been worse for them.
It was terrible timing. Europe had just emerged from the winter of 2025 into 2026. And due to a series of cold snaps, their regional natural gas storage levels were heavily depleted. Our data shows they were sitting at roughly 30% capacity.
Wait, let me put that in context for you listening. Europe spent years fundamentally restructuring their energy grid away from Russian pipeline gas, leaning heavily into these seaborne LNG imports.
Yes, exactly.
So they are totally reliant on these ships arriving on schedule, and they only have a 30% buffer left in the tanks.
That is exactly the vulnerability, because natural gas is the primary heating fuel and a massive component of industrial electricity generation in Europe. So when the Qatari LNG shipments halted, the European energy markets realized they might not have enough fuel to rebuild their storage reserves before the next winter.
And what did that do to the price?
The Dutch TTF gas benchmark, which is the primary pricing reference for European natural gas, went vertical. It spiked to over 60 euros per megawatt hour.
Wow. And the economic dominoes fell incredibly fast after that. The sources track how the European Central Bank was basically immediately backed into a corner. They had been planning to cut interest rates to stimulate a sluggish economy.
Right, but suddenly with energy costs doubling, inflation forecasts skyrocketed. The ECB had to abruptly halt those planned rate cuts.
Yeah, you had heavy manufacturing sectors in Germany warning of a severe impending recession because it simply costs too much to keep their factories running.
And the contagion spread into incredibly niche, vital markets that most people never even think about.
Like what? Give me an example.
Well, when energy prices spike that aggressively, heavy industry shuts down. Aluminum smelters in Bahrain and the wider Gulf region had to curtail production.
Oh, wow.
And fertilizer prices surged globally because natural gas is a primary feedstock for nitrogen-based fertilizers. That instantly threatened global agricultural yields and raised the specter of massive food inflation.
Even the helium market was severely disrupted, according to the reports.
Right.
Which sounds like a trivial issue, until you realize helium isn't just for party balloons.
Right. It's a critical component for cooling the superconducting magnets in MRI machines, and it is absolutely vital in the manufacturing process for semiconductor microchips.
It was a true multi-layered systemic shock. The International Energy Agency literally classified this as the largest supply disruption in the history of the global oil market. They were drawing direct, terrifying parallels to the 1970s energy crisis.
And the 1970s comparison is highly relevant here, because during the Arab oil embargo of the 70s, the sudden scarcity of fossil fuels triggered an immediate panicked realization that Western nations needed alternative, domestically secure sources of baseload power.
Right, and that crisis was the catalyst for the massive build-out of the nuclear fleets in France and the United States.
Exactly.
Which brings me to the fundamental question that makes this entire Q1 scenario so bizarre.
The paradox.
The paradox. If we look at this through the lens of the 1970s energy crisis, isn't this exactly what should trigger a massive, sustained spike in all alternative energy markets, including uranium? If the lights are threatening to go out in Europe, shouldn't uranium have shot straight to the moon and stayed there?
You would think so, but it didn't, because the mechanism that prices uranium in the short term is entirely divorced from the mechanism that consumes uranium in the long term.
Okay, so to understand why the ultimate safe haven asset crashed during a crisis, we really have to dissect the anatomy of the uranium spot market.
Yes. Let's look at the exact timeline of the spot market roller coaster from the Q1 Strategic Analysis Report.
Okay, so the quarter actually began with tremendous momentum. On January 1st, the spot price was sitting around $81.84 per pound. And throughout January, the price was steadily climbing.
Driven by strong foundational demand and very aggressive financial buying.
The concept of financial buying is the key to unlocking this whole mystery.
It absolutely is, because the uranium spot market is the arena where physical material is traded for near immediate delivery. It is an incredibly small, illiquid market compared to global commodities like copper or crude oil.
Right.
And over the last few years, it has become heavily dominated by specialized financial entities, the most significant of those being the Sprott Physical Uranium Trust, or SPUT.
Okay, I want to make sure I understand the mechanics of SBU clearly. And for you listening, this is super important. If I'm an institutional investor and I buy shares in SBU on the open market, what is actually happening behind the scenes? Am I just trading paper derivatives?
No, and that physical reality is what makes SBU so disruptive to the market. SBU operates an at-the-market, or ATM, mechanism.
Okay.
So when investors buy shares of the trust, SBU takes that capital, goes directly into the spot market, and purchases physical drums of uranium concentrate known as U3O8. They then transport that material to highly secure, licensed storage facilities in North America or Europe, and they lock it away.
Wow. So they act as a one-way vacuum. They are permanently removing supply from an already tight market.
Structurally, yes. Their mandate does not allow them to easily sell that material back into the market to capture a quick profit. They are a sequestration vehicle.
Interesting.
And in late January, SBT, having recently renewed their prospectus and secured fresh capital, began aggressively utilizing this mechanism. The sources pinpoint January 28th as a critical inflection point.
What happened on the 28th?
On that single day, SBUT purchased 500,000 pounds of physical uranium.
Wait, 500,000 pounds? In one day?
In a single day.
That is a staggering amount of material to just pull off the board.
It was their largest single daily purchase in 3 years. In an illiquid market, that level of sudden buying pressure acts like a match in a powder keg.
And the market reacted exactly as the physics of supply and demand dictate. The very next day, January 29th, the spot price surged to $101.41 per pound.
That was a massive psychological and financial milestone.
Yeah, it was the year-to-date high and the first time uranium had crossed into triple digits in over 2 years. Everyone analyzing the sector assumed the fundamental energy crisis was finally being priced into the fuel.
But then February hit.
Ah, right. Along with Operation Epic Fury, the assassination of Ali Khamenei, and the closure of the Strait of Hormuz.
Exactly. And this is where the paradox really hits. Because the broader global markets look at a closed strait, they look at spiking inflation and massive energy disruption, and they panic. Broad equity markets sell off sharply.
And what happens to uranium? It crashes right alongside them. The data shows the spot price plummeted nearly 16% in a single week.
Just a total collapse.
Yeah, dropping down to $85.50 by February 5th. It essentially erased that entire January rally in a matter of days, ending the quarter with just a muted positive bump at $83.90.
The disconnect seems totally illogical until you look at the liquidity chains.
Okay, explain that.
When the global macro environment enters a state of panic, investors shift into a risk-off posture. Asset managers are facing margin calls across their broader portfolios, so they are forced to liquidate assets indiscriminately just to raise cash.
They dump equities, they dump commodities.
Right, and they flee to traditional safe havens like the US dollar or short-term treasuries.
So because SBU is a publicly traded vehicle, its shares get caught up in that massive indiscriminate wave of selling. Investors are pulling their money out of the trust not because they hate uranium, but because they desperately need liquidity everywhere else.
Precisely. And when SBUT's share price drops below the net asset value of the physical uranium it holds, the trust's ATM mechanism shuts down.
Oh, they can no longer legally raise capital without diluting their existing shareholders.
Exactly. And if SBT cannot raise capital, they instantly stop buying in the spot market.
So the stock market is essentially acting like a hyper-caffeinated day trader reacting to Twitter headlines, completely ignoring the actual power plants that need fuel to keep the lights on.
That's a great way to put it. The spot market prices liquidity and sentiment. But the power plants do not operate on sentiment. They operate on thermodynamics and long-term planning. Which brings us to the actual utilities.
Right. And this is where we need to look at the term market. Because while the spot market was busy having a 16% panic attack, the long-term contracting price was telling a completely different story.
Completely different.
Yeah, according to the Q1 analysis, the term market completely decoupled from the spot chaos. The long-term contract price climbed steadily and relentlessly throughout the entire quarter.
Ending Q1 at $90 per pound.
Which is a 17-year high. I mean, we haven't seen a long-term price that robust since the previous commodity supercycle back in 2008.
And that divergence, between a crashing spot price and a surging term price, it's the most important signal in the entire data set.
Why is that?
Because the term price represents the reality of physical supply and demand over a multi-year horizon. A utility signing a term contract today is locking in deliveries for 2027, 2030, and beyond. They are looking at the fundamental math of the industry, and frankly, that math is terrifying.
Okay, let's lay out the fundamental math from the sources, because this structural deficit is massive.
It really is.
In 2025, the total world primary production of uranium out of the ground was roughly 173 million pounds. But the global fleet of nuclear reactors actually consumed approximately 204 million pounds.
That is a structural deficit of over 30 million pounds in a single year.
30 million pounds?
Yeah. And a 30 million pound shortfall is not a rounding error. It represents a fundamental inability of the mining sector to feed the existing infrastructure. And it is the direct result of over a decade of severe underinvestment.
Right. After the Fukushima disaster in 2011, uranium entered a brutal decade-long bear market. Prices stayed artificially depressed for years, and utilities grew complacent.
Extremely complacent. The sources note, quoting Cameco's management directly, that global utilities have not contracted for new uranium at replacement rates since 2012.
Wait. Let me get this straight. So for over a decade, power plants have just been burning through fuel faster than they are signing contracts to replace it.
Yes.
How did the lights stay on?
Well, they survived by cannibalizing secondary supplies. They drew down massive historical stockpiles. They relied on commercial enrichers underfeeding their centrifuges just to squeeze out extra material.
But those secondary buffers are finite.
Exactly. And they've largely been exhausted. We've reached the point where the physical reality of the mine supply must meet the physical demand of the reactors.
And Cameco explicitly stated that forward demand has, quote, never been bigger. Utilities are waking up to this 30 million pound deficit, realizing they are utterly exposed. and they are bidding the long-term price up to $90 just to guarantee their survival.
Which leads us to a really fascinating mechanical interaction between these two markets, something mentioned extensively in the reports.
Ah, yes, the carry trade.
The carry trade arbitrage mechanism.
Okay, wait. Let me unpack this because I was struggling to wrap my head around it. The sources talk about this carry trade effectively putting an artificial floor under the spot price, stopping it from crashing further.
Yes, it acted as a critical shock absorber during the Q1 geopolitical panic.
I'm stuck on the logistics, though. How does someone just arbitrage a highly regulated physical radioactive metal? It's not like flipping a stock.
It's not, no.
Like if I see spot uranium crashing to $84 and I know I can sell it into a term contract for $90, it sounds like an easy $6 profit. But if I buy it today to fulfill a contract delivering in 4 years, I have to pay to store heavily regulated material for almost half a decade. Doesn't the cost of capital plus insurance plus specialized storage completely wipe out my margin?
It's an excellent question, and it really highlights why the carry trade is restricted to highly sophisticated, well-capitalized intermediaries. You are totally correct that carrying physical inventory incurs costs. You have the cost of capital, the interest rate you pay on the money borrowed to buy the spot material, and you have storage fees at the licensed conversion facilities. However, uranium has a unique physical advantage.
Which is?
Extreme energy density. A single 55-gallon drum of uranium concentrate holds an immense amount of financial and energy value, which means the physical storage footprint, and therefore the storage cost per pound, is surprisingly low compared to holding millions of barrels of oil or maintaining vast tanks of LNG.
Okay, so the storage isn't as punitive as I was imagining.
Exactly. And regarding the cost of capital, these specialized traders utilize leverage and incredibly sharp forward curve modeling. When the spot price crashed down toward $84 due to the SBUT liquidity vacuum, the spread between spot and the $90 term price widened significantly.
Oh, I see.
The math suddenly crossed the threshold of profitability. A trader could step in, secure massive lines of credit, buy the cheap spot material at $84, and immediately ink a forward contract with a desperate utility at $90. They lock in the spread, completely hedging out the price risk.
Okay, but if the spread is that guaranteed, why doesn't every hedge fund on Wall Street jump in and arb the difference?
Because of the regulatory moat. To buy and hold physical U3O8, you must possess a highly scrutinized account at a licensed nuclear facility, overseen by regulatory bodies like the Canadian Nuclear Safety Commission or the U.S. Nuclear Regulatory Commission. You can't just open an E-Trade account and take delivery of uranium.
Oh, yeah.
That regulatory barrier eliminates 99% of financial players. It leaves the carry trade to a small cabal of specialized funds and trading houses.
So when SPU vanished and the spot price was in free fall, these licensed carry traders effectively stepped in as the buyer of last resort.
Yes. They acted as a vital shock absorber. They recognized the dislocation between the paper panic and the physical scarcity. By stepping in to buy the cheap spot material to feed into their highly profitable term contracts, they generated massive buying pressure that arrested the crash.
They established a hard floor under the market.
Exactly, proving that the physical necessity of the $90 term market ultimately dictates the baseline reality, even when the spot market loses its mind.
Okay, so the long-term price isn't just rising because standard utilities are waking up from a decade of complacency. It's rising because entirely new, massive players have entered the chat.
Sovereign nations.
Sovereign nations.
Right.
This feels like a massive paradigm shift. Let's detail the absolute behemoth of a deal that Q1 delivered to illustrate this, because in early March, Cameco announced an agreement with India's Department of Atomic Energy.
It is difficult to overstate the magnitude of the Cameco India contract. It's a 2.6 billion Canadian dollar agreement. Yeah. Cameco is committing to supply nearly 22 million pounds of uranium ore concentrate over a 9-year delivery window, stretching from 2027 to 2035.
22 million pounds. We just established that the entire global structural deficit right now is roughly 30 million pounds.
Right.
And India just stepped into the market and unilaterally swept 22 million pounds of future supply completely off the table for themselves. And the optics surrounding this deal were incredibly telling, too.
Oh, the optics were everything. This wasn't quietly signed via email between procurement managers. It was signed in New Delhi. Tim Gitzel, the CEO of Cameco, was on stage alongside Indian Prime Minister Narendra Modi and Canadian Prime Minister Mark Carney.
The presence of two heads of state elevating a corporate supply contract to the level of international diplomacy tells you everything you need to know about how critical this is.
Definitely. India operates 24 nuclear reactors today. However, their explicit state-mandated goal is to achieve 100 gigawatts of nuclear power capacity by 2047.
To put that in perspective for you listening, 100 gigawatts is roughly equivalent to the entire nuclear output of the United States today. They're trying to build a grid of that scale, essentially from scratch.
And they recognize a hard truth. Their domestic uranium reserves are relatively low-grade and insufficient to fuel a massive modern reactor fleet. They desperately need access to the high-grade ore found in places like Canada's Athabasca Basin.
So when the Indian government looked at the geopolitical landscape, when they watched the Strait of Hormuz close and saw 20% of global oil and LNG held hostage, they made a calculated, sovereign decision.
Yes, they realized they cannot build the foundation of their future economy on supply chains that are vulnerable to regional wars.
Because nuclear fuel offers ultimate energy density. A single gymnasium-sized warehouse can store years of baseload power. Sovereigns like India aren't haggling over price anymore. They are paying whatever it takes to guarantee security of supply.
And India is far from the only giant hoarding material.
Right. The Q1 Strategic Analysis Report details moves by China that completely warp the demand curve. The data shows China recently imported nearly 70 million pounds of uranium in a single year.
70 million?
Are we sure they are actually consuming that much, or are they just indiscriminately hoarding? Because 70 million pounds is roughly 40% of the total primary production of the entire planet.
Right.
One country just bought 40% of the global supply in a year.
Oh, they're absolutely hoarding it. They're operating far beyond their immediate consumption needs. What China is doing is building the nuclear equivalent of the Strategic Petroleum Reserve.
Wow.
They are aggressively buying physical material on the global market and stockpiling it domestically. They are insulating their massive, rapidly expanding reactor fleet from any future Western sanctions or global supply chain breakdowns.
That's incredible.
They're absorbing massive quantities of material that Western utilities just assumed would always be available to them on the spot market.
It's like a game of global musical chairs. But the chairs are strategic fuel supplies. And instead of just utility companies walking around the circle, entire governments are shoving them out of the way. If China and India lock up the supply, what is left for the Western utilities?
Well, and then you add the domestic policy of the United States to this pressure cooker.
Oh, yeah. The sources highlight that the U.S. government recently formalized support and funding to construct 10 new advanced nuclear reactors.
10 new reactors. If you run the physics on what 10 brand new reactors require, not just for standard annual refueling, but the massive initial core loads required to start them up for the first time, you are looking at approximately 65 million pounds of incremental demand over the next decade.
That is the critical word. Incremental.
Yeah.
That 65 million pounds of demand mathematically requires fuel that no one had modeled into demand forecasts a few years ago.
It is entirely new demand being dropped onto a market that is already drowning in a 30 million pound deficit.
And the land grab is accelerating. The reports show Kazatomprom, the state-owned uranium producer of Kazakhstan, which, by the way, is responsible for over 40% of global supply, is actively signaling they want to establish parallel long-term mega deals with India.
So if China is vacuuming up 40% of global production for a strategic reserve, and India is locking in 22 million pounds of Canada while courting Kazakhstan, and the U.S. needs 65 million pounds for new builds,
What on earth is left for the legacy utility operators in Europe and America?
they are facing a harsh new reality. The pool of uncontracted available material is shrinking rapidly. They're going to be forced into highly competitive bidding wars just to secure basic operational fuel.
So if the superpowers are buying up all the supply, where's the new supply going to come from? This entire dynamic mathematically necessitates a massive response from the supply side.
It does. And Q1 2026 actually provided some historic structural green lights for massive new supply projects. Canada, in particular, dominated the headlines.
Let's break down those major supply milestones from the sources. The Canadian Nuclear Safety Commission, or CNSC, issued several monumental decisions in Q1.
The most critical development was the advancement of next-gen energy.
Yes, and we need to be very specific about this asset. For you listening, we must explicitly refer to and pronounce this project as Rook 1. The CNSC granted full site preparation and construction approval for NextGen's flagship project, Rook 1.
Rook 1 is widely considered a generational asset. It's located in the southwestern quadrant of the Athabasca Basin in northern Saskatchewan, which is the premier jurisdiction for high-grade uranium globally.
And the feasibility numbers are astounding. We are looking at measured and indicated mineral resources of over 250 million pounds of uranium.
Getting the final sign-off from the notoriously rigorous CNSC to actually put shovels in the ground for site preparation and construction is a massive de-risking event.
The scale of a quarter-billion-pound deposit is difficult to conceptualize. It's clear why the market reacted so strongly to that approval. Rook 1 has the potential to act as a central pillar of global supply for decades.
Absolutely. But NextGen wasn't the only major Canadian victory in Q1.
Right. Denison Mines also received final CNSC approval for their Phoenix deposit at the Wheeler River project. And this one is technically fascinating. Phoenix is the first fully permitted uranium mine to enter construction in Canada in over a decade.
And it is going to be utilizing in situ recover, or ISR, technology in the Athabasca Basin.
The approval of ISR in Saskatchewan is a technological watershed moment, isn't it? Historically, the high-grade deposits in Canada have been extracted using conventional methods, either massive open pits or incredibly complex underground shaft operations.
Yeah, involving freezing the groundwater just to prevent flooding. ISR is a fundamentally different approach.
Can you break down the actual fluid dynamics of ISR for us? How does it differ from traditional mining?
Well, ISR is vastly less invasive. Instead of physically moving millions of tons of waste rock to reach the ore body, you leave the rock in place.
Yay.
You drill a highly engineered network of injection and recovery wells into the specific geological formation holding the uranium. Then, you pump a specialized aqueous solution, the lixiviant, down into the ore zone.
Oh, interesting.
This solution moves through the natural permeability of the rock, chemically dissolving the uranium minerals while leaving the surrounding rock intact.
So you're basically liquefying the target metal underground.
Exactly. You then pump that uranium-bearing fluid back up to the surface. It flows into a processing plant where the uranium is stripped out of the liquid using ion exchange columns. The barren solution is then recharged and re-injected into the ground in a closed-loop system.
Wow. The environmental and economic advantages seem obvious. You have a vastly smaller surface footprint, no massive tailings dams holding waste rock, and presumably a much lower initial capital expenditure since you don't have to build a giant underground city.
The economics of ISR are generally incredibly robust, which is why Denison spent nearly a decade rigorously testing and proving to the CNSC that they could safely deploy this technology in the unique geological conditions of the Athabasca Basin. Getting the final green light for Phoenix proves that high-grade ISR is a viable reality in Canada.
Okay, so Canada is locking in the massive generational projects, but building those takes time. The U.S. seems to be taking a different approach, focusing on immediate, smaller-scale restarts. The sources show actual new production coming online in the U.S. in Q1.
The United States is desperately trying to resurrect its domestic uranium supply chain. In Q1, Uranium Energy Corps, or UEC, officially commenced production at their Burke Hollow project in South Texas. This is highly notable because it's the first brand new greenfield ISR operation to begin producing in the U.S. in over a decade.
And they weren't alone. Air Energy announced the start of ISR operations at their Shirley Basin site in Wyoming, bringing a historically prolific uranium district back into active production.
Right. And globally, Paladin Energy upgraded their guidance for the Langer-Heinrich restart in Namibia. And Kazatomprom reported highly disciplined but slightly increased year-over-year production in Q1.
Okay, I have to stop and push back on this narrative of a supply renaissance, though.
Go ahead.
When I read these headlines, first mine in a decade, Texas is back online, it creates the illusion that a tidal wave of new uranium is about to flood the market tomorrow and effortlessly erase that 30 million pound deficit.
Right.
But if I look at the physical numbers, Burke Hollow and Shirley Basin produce a fraction of what China just bought in 1 year. Are these green lights actually going to close the structural deficit, or are they just a drop in the bucket? And the timeline for the massive Canadian projects seems to be the real catch here.
Your skepticism is entirely warranted. Headlines do not fuel reactors. Only physical pounds of process U308 can do that. And the physical timeline of mining is the sobering reality check to the entire market narrative.
Right.
The mining industry operates on a lag time measured in half decades, not months. Take Denison's Phoenix project. Even with the regulatory approvals in hand and the faster construction timeline inherent to ISR technology, they are currently targeting their first commercial production in 2028.
Wow, 2 years from now.
at least. And Rook 1, despite its monumental scale, is a highly complex underground engineering project in the remote frozen north. It will require several years of intense construction and hundreds of millions of dollars of capital expenditure before it produces a single pound of commercial ore.
So all of these Q1 green lights, as historic as they are, provide essentially 0 physical pounds of new supply to the market right now.
Exactly. In the immediate term, they do not alleviate the crunch. They are absolutely critical for securing the supply picture in the 2030s. But today, the 30 million pound structural deficit remains fully intact.
In fact, given the aggressive sovereign buying and the new U.S. reactor builds we discussed, that deficit will almost certainly widen substantially before Rook 1 or Phoenix can reach commercial production to help fill the gap. That harsh physical reality brings us to our forward-looking outlook. With the physical reality of the supply timelines lagging years behind the frantic sovereign demand, we have to look ahead. Now that we are in June, what is the forward-looking opinion for Q2 and beyond based on Q1's data?
The most critical forward-looking metric highlighted in the Q1 strategic analysis is the incentive price. The market is staring at a demand curve that is rapidly accelerating toward 250 to 300 million pounds annually by the end of the decade.
Okay.
To incentivize enough new global production to meet that demand, meaning to mathematically justify the billions of dollars of capital expenditure required to finance and build the Rook ones. And the Phoenixes of the world analysts estimate the true required incentive price is now between $125 and $150 per pound.
$125 to $150. The spot price ended Q1 at $83.90. That is a gargantuan chasm that the market needs to cross.
It's a massive gap. And it's driven by years of inflationary pressures on labor, steel, and energy inputs for the mining sector. To see how the market attempts to close that gap in Q2 and beyond, we are monitoring 3 specific catalysts.
What's the first one?
First, the macroeconomic environment, specifically tied to the Strait of Hormuz closure. If the geopolitical tension eases and the broader equity markets recover their risk appetite, capital will flow back into the system.
Which directly feeds the second catalyst, right?
Yeah.
The return of SPUT.
Yes.
Because if institutional capital flows back into equities, SPU can raise funds and re-engage their ATM mechanism. The reports indicate SPT still has an authorized capacity to purchase up to 9 million pounds annually.
And if they deploy that capital into a market that is already structurally devoid of physical supply, we know exactly what happens. We saw it in January when they pushed the price up $20 in a month.
Precisely. The liquidity vacuum operates in both directions.
Right. And the third, and ultimately the most structural catalyst, is utility behavior in the term market. Will we see the legacy operators begin signing mass contracts at or above the current $90 benchmark?
And when utilities universally accept that triple digits are the new permanent floor required to guarantee their survival, the entire economic model for the development stage miners shifts into high gear.
It does.
So you're saying that the $101 spike we saw in January wasn't an anomaly, but rather a preview of the new normal once the geopolitical panic subsides.
That is the most logical interpretation of the data. The January peak was a fundamentally sound valuation temporarily suppressed by a profound macroeconomic shock. As the noise of the Hormuz crisis clears, the gravity of physical scarcity will inevitably pull the price back toward the required incentive levels.
As we wrap up this deep dive, I want to leave you with one final, slightly provocative thought to mull over. We spent the last hour meticulously detailing how a massive geopolitical war caused an energy crisis that, ironically, crashed the spot price of uranium due to a panicked liquidity crunch. But what if we see the exact inverse play out over the coming months? Imagine that tomorrow, a historic peace treaty is brokered in the Middle East. The blockade ends, the Strait of Hormuz is completely unblocked, and 10 million barrels of oil and massive fleets of LNG tankers flood back into the global market. What if that profound geopolitical stabilization actually causes a severe temporary drop in the spot price of uranium?
It is a brilliant contrarian scenario. Think about the psychology of the market. If the acute, terrifying energy panic evaporates,
Yeah.
if Brent crude oil plummets back to $70 a barrel, and the broader market celebrate the return of cheap energy. The sudden fear premium that has forced politicians to suddenly embrace nuclear power might vanish overnight. The urgency to build out national stockpiles might disappear from the front pages.
Exactly. The algorithmic day traders and generalist funds might look at peace in the Middle East, look at crashing oil prices, and dump their uranium equities, assuming the broader energy crisis has been permanently solved. Yet, consider the physical reality we just mapped out. If the spot price crashes on a peace treaty, that 30 million pound structural deficit will still exist.
Yeah.
China will still be quietly locking away 40% of the world's primary production in its strategic reserves.
India and Cameco will still be executing their 9-year, 22 million pound mega deal.
Right. And it will still take several long, expensive years before Rook 1 and Phoenix are capable of mining a single ounce of commercial ore. All of that undeniable physical reality will remain completely unchanged in the background, regardless of what the price of oil is doing on a screen.
Which leads to the ultimate strategic question for anyone navigating this sector. Does peace create the ultimate contrarian buying opportunity for nuclear fuel right before the physical supply deficit truly bites?
That is the paradox we leave you to ponder as you look at your screens and analyze your portfolios tomorrow morning. Thank you so much for joining us on this deep dive. It is an incredibly complex, contradictory macroeconomic landscape out there. But taking the time to let the geopolitical dust settle, stepping away from the daily panic, and rigorously interrogating the hard data is the only reliable way to navigate it. Keep questioning the consensus, keep exploring the hidden mechanics of the supply chain, and we will see you on the next deep dive.